What if I told you that playing it safe could earn you an extra year's worth of gains in the stock market by playing defense? Well, that's exactly what you're going to see today. You've probably heard the term before, but what exactly is the defensive sector and what can it do for us? It's simply a group of stocks that experience less volatility when markets decline. We measure a stock's degree of volatility by using beta. When the stock's beta is greater than 1, it means the stock is more volatile than the S&P 500. When the beta is less than 1, the stock is less volatile than the index. Defensive stocks by nature have a very low beta. Take, for example, the following commonly held shares: Nvidia, Tesla, and Apple, all in the technology space, very volatile, with high betas greater than 1. Then we have the defensive positions: Procter and Gamble, Johnson & Johnson, Duke Energy, very low betas, much less volatile than the index. And by the way, certain stocks are defensive in nature because we always need the goods they produce. We call this inelastic demand. Things like toothpaste, food, electricity, and healthcare. We always need these things regardless of GDP and the state of the economy. For that reason, defensive stocks are much more stable than other groups. Exactly which sectors are considered to be defensive? They include consumer staples, utilities, and healthcare. We can participate in these sectors through the use of commonly held exchange traded funds, ETFs, like XLP, XLU, XLV. Great examples of defensive stocks include Coca-Cola, Duke Energy, and Johnson & Johnson. An extra benefit to defensive stocks is they also pay high dividends. The reason being, these companies have stable cash flows because of the consistent demand for, toothpaste. Of course, they don't perform as well as the more volatile technology names, so the companies pay high dividends to attract long-term investors. Johnson & Johnson, Duke Energy, and Procter& and Gamble all pay dividends of $4 to $5, even more. Not too bad. On the other hand, those high flying tech names like Apple, Nvidia, and Tesla pay very low dividends, and sometimes none at all. So, how do defensive stocks perform in a recession? Is it worth the trouble? Let's consider the annual performance in the year 2008. That wasn't a good year. The S&P 500 was down over 36%. The cyclical sectors like retail, energy, and technology lost even more, around 40% for the year. Defensive sectors declined as well, but much less. The continuous demand for staples, healthcare, and utilities ensured their businesses would survive the fall. Now comes time for the investment strategy. How do we incorporate defensive stocks into our portfolio? Very simply, during economic contractions, we're going to rotate out of the S&P 500 and into a basket of defensive ETFs. We've created a basket of equally weighted portions of XLP, XLV, and XLU, staples, healthcare, and utilities. But when to pull the trigger? We've backtested the data, and here are the strategy rules. It's super simple. Sell our S&P 500 position and buy the basket of defensive ETFs when the Fed cuts rates for the first time in a new cycle. Meaning, after a healthy bull market, when the economic numbers begin to soften, the Fed will start cutting rates, like they just did recently. Let's see what this looked like. Take 2001. Following that tremendous dot-com bull market, the Federal Reserve reduced interest rates for the first time on January 3rd, 2001. The stock market had already begun to soften, but the worst days were yet to come. We all remember the booming days of 2007, a surging economy and a surging house market. The Federal Reserve cut interest rates on September 18, 2007, as the data began to deteriorate. These Fed cuts were exactly the signal to shift from the S&P 500 to a basket of defensive ETFs. By the way, fast forward to present date, the Fed once again cut rates on September 17th, just a few weeks ago. That's exactly why we're talking about this now. Okay, back to the strategy. We've moved our investment capital into a basket of defensive ETFs. When do we get out? When move back into the S&P 500? The exit trade will be triggered by the VIX. The VIX, Volatility Index, is comprised of the front-month options on the S&P 500. It's also known as the fear gauge. When stocks go down, the VIX goes up. When markets crash, the VIX may spike up to 50, 60, or even higher. This is what the exit trade looks like. In 2008, the VIX soared as markets plummeted. On May 19th, the VIX crossed back below 30 for the first time in a very long time. Notice this strategy kept us in the defensive, low volatile sectors during most of the recession. Of course, nearly all stocks went down, but these low beta names suffered much less than those high flying technology and housing stocks. Back to our strategy rules. Shift investment capital out of our basket of defensive ETFs and buy back the S&P 500 at very cheap prices. So we followed the rules and executed the strategy. How did it perform? In the market crash following the dot-com bubble of 2001, if we had just held on to the S&P 500 and ignored the strategy rules, we would have lost over 8%. But our basket of defensive plays lost only 3.5%. By playing defense, we saved around 4.7%. But it gets better. In the 2008 crash, ignoring the strategy rules, the S&P 500 lost over 40%. This was bad. The defensive strategy saw declines of around 25%. The defensive basket buffered the losses and saved around 15%. In the 2020 crash, ignoring the defensive strategy, the S&P 500 lost over 9%. Our strategy declined 6%, outperforming the broad markets by 3%. Considering the net effect of this strategy over the past 3 recessions, the average returns of simply holding on to the S&P 500, ignoring our rules, lost almost 20%. During the same period of time, the defensive strategy lost 11.5%. A portfolio utilizing defensive ETFs outperformed the index by 7.8%. Keep in mind, over the past 24 years, the S&P 500 averages around 7.9% annually. So effectively, by simply incorporating a defensive strategy following 2 simple trade rules, gain an entire year's worth of profits. We've written about this strategy in greater detail, just published in our Substack newsletter. We'll provide a link in the description of this video. Let us know what you think. Is this helpful? Interesting? What do you think about the fact the Fed just cut rates for the first time in a long time last month? Will history repeat? We hope this has been helpful. We look forward to seeing you back soon.